It's been an incredibly important week in financial markets, with a number of central banks announcing their latest interest rate decisions and some providing new forecasts which could lay the foundations for interest rate cuts next year. The two that really stand out in that category are the Federal Reserve and the European Central Bank, and both took a very different approach, although you would never guess that based on market based expectations. The Fed first announced on Wednesday that it was leaving interest rates unchanged, but alongside its new forecast, it also released its dot plot showing where policymakers on the FOMC believe interest rates will be over the next few years. And the median forecast for 2024 is that there would be 75 basis points of rate cuts. And that almost fell in line with where markets were positioned and caught many people off guard. The Fed at the last forecast meeting in September expected one more rate hike and had no inclination of talking about interest rate cuts. So there's been quite the pivot from the Federal Reserve because inflation has been falling and we've seen some softening in the labor market and the economy. And that caused market expectations to shift considerably. If you bear in mind that prior to this meeting, markets were factoring in 4, maybe 5 interest rate cuts next year, expecting the Fed to maybe allude to 1 or 2 over the course of the next 12 months. Because the Fed went further to meet the markets in the middle, the markets did what they do best. They went further away again and are now pricing in 6 interest rate cuts of 25 basis points or 150 basis points of rate cuts in total next year. Now, if we compare that with what we're expecting from the European Central Bank, you would think that that press conference went very much the same way, but you'd be surprised. The ECB is expected also to cut interest rates next year by 150 basis points based on market rate expectations, or 25 basis points rate cuts. So you'd be forgiven for thinking that the ECB had alluded to something similar, but they did something quite different. In fact, they pushed back against market expectations, talked about ongoing higher unit labor costs and higher wage growth as that has been a concern and an upside risk to inflation, despite the progress that has already been made, which begs the question, why did they take this approach? And it could be as simple as timing. The Federal Reserve announced its decision on Wednesday, and on the basis of that, interest rate expectations across the board fell, which means that markets were pricing in more rate cuts from central banks, not just the Federal Reserve, but other central banks too. So there's every chance that the ECB went into this meeting seeing how much financial conditions had already eased and decided that they need to push back against these expectations rather than add more fuel to the fire. And that may be why they've chosen such hawkish language, even if they do anticipate there will be rate cuts next year. And the ECB don't release a dot plot, so there was no reason for them to commit to language which would suggest there could be multiple rate cuts on the agenda next year. So I think that may have a big role to play in it, but also may explain why markets have shrugged off their more hawkish rhetoric. Now let's take a look at what that means ultimately for the markets. And as you can see, two things have unfolded here. The euro has strengthened both on Wednesday and on Thursday. On Wednesday, probably more driven by the dollar move, but on Thursday, potentially driven by a bit of an upside move in the single currency as well because of that more hawkish rhetoric. And what that means is the pair over the last week or so has actually, having pulled back towards that 50 fib around 107.30, has rotated off the 50 fib, which combined also with the 55 day simple moving average, and moved higher. And now we find ourselves at a very interesting level because having rotated here higher from 107.30 back towards 110, we're now at those previous highs that we saw at the end of November, but also 110 is a big psychological test as well for the pair. So now there's a big test potentially coming. Now the momentum indicators don't offer us too much inclination at this stage as to where things are going to go. If we look down onto a shorter time frame, you may be able to see signs of momentum shift, but again, there's not really any signs. If you look at the most recent high up here and look down, there's no signs of divergence forming on those highs. The momentum indicators have shifted lower over the course of the last few candles, but so has price. So that is what you would expect. Then you look at candlestick formations, because if this is a rally that still has momentum, then the candlestick formations can give you some idea on whether we are seeing a corrective move in a broader rally, or maybe you're seeing a consolidation, maybe a bullish flag formation, or a falling wedge formation. But it doesn't really suggest we're seeing either of those two things. In fact, this kind of looks like a small double top with the two peaks here over the course of the last couple of days, and the neckline here around 109.75. Now, we've broken below that, and you could even argue that actually the breakup from there has almost completed, and then we've seen a bit of a rising pattern formation here. So perhaps what we're seeing here, even though there wasn't that much of a divergence or any divergence really on the 4-hour or the 1-hour chart during the rally that we saw into 110, but maybe we are just seeing a minor corrective move, perhaps on profit taking. I always say that while big round numbers shouldn't have a massive influence on how price action moves around those levels, it often does. And we can see that 110 previously, as I highlighted on the daily chart before, from that previous high at the end of November, price rotated off 110, and there's no fundamental reason why that should have been the case. Now we're potentially seeing some profit taking again. The question is, are we seeing a rotation back towards that 50 fib level and potentially a larger double top formation arriving here, or are we seeing a smaller corrective move, at which point the fib levels could be key in determining whether we're going to see another run at 110 again? Based on the fact that there's been plenty of momentum into that 110 area, I am inclined to keep a close eye on these fib levels that I'm highlighting on the 4-hour chart here, being those 8th of December lows through to the 14th of December highs, to see if we can see any signs of momentum shifting as it declines into that area, assuming it reaches that far before potentially rotating higher. So that's the areas I'm going to be keeping a close eye on in the short term. But broadly speaking, we have two central banks who are on the same page. We have two central banks, whether one would like to admit it or not, that is moving towards cutting interest rates next year, or is likely moving towards cutting interest rates like next year, wants to see more evidence that that is going to be the case, or at least it wants markets to believe that's the case, but it still believes that inflation is going to fall back to 2% over the next 2 years. And we have another central bank that is very explicit about doing so. The end result is that markets think we're going to get 150 basis points of rate cuts from both central banks next year. Very bullish, very aggressive. And it seems that from the market's perspective, the great pivot that we've been waiting for quite some time on interest rates has now arrived going into the end of 2023.